Today's show is brought to you by TestCube. Are flaky tests slowing your Kubernetes deployments? TestCube powers continuous, cloud-native testing directly inside your Kubernetes clusters. Seamlessly integrate your existing testing tools, scale effortlessly, and release software faster and safer than ever. Stop chasing bugs in production. Start preventing them with TestCube. Check it out at testcube.io/cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are. Welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Another weekend perspective. Hope everybody's doing well. Middle of November continues to move on. The weather is getting to be a little bit unpredictable. We had some snow here in North Carolina a few days ago. We back up to about 70 degrees, a week later. So still in sort of the unpredictable time. The weather is, not necessarily cooperative. The daylight is not necessarily cooperative, but we continue to plow along. We are, just a week or so out from Thanksgiving, my favorite holiday, my favorite sort of long holiday weekend. Hope everybody's doing well. There's a show that I watch, or there's a show that I listen to, or at least a personality I listen to on certain shows. A guy named Scott Galloway. He goes by Prof G. He does a bunch of different shows, but he used to have a podcast in which he started off the show with a number. I think it was the Prof G podcast. It might have been something else. But anyways, he would always sort of start off and he would go, today's number is 47. And then he would rattle off a bunch of statistics that had the number 47 in it, whether it was like, the number of states that, didn't have, had daylight savings time, or the number of, molecules in a granule of something. It was just kind of this way of taking a number, which is typically the show number they had for the year or all time, and weaving it in with a bunch of stats that, may or may not be completely related to each other. And I got to thinking about that because I've been trying to figure out a way to put some numbers, put some rationality around the things that are going on in the cloud and the AI market, in particular, kind of the AI market, but both as it relates to both of them. And, as I was thinking about that throughout the week, it really sort of dawned on me that we are in a time in which, when you look at the actions that people are taking, on one hand, they seem relatively rational if we put it in the perspective of, we're still in very, very early days. And they also at the same time seem completely irrational in terms of being able to be financially justifiable or economically viable or able to be kept up with the demand that exists within the world, or all sorts of things. And so I wanted to kind of dig into some numbers, whether they are good numbers or bad numbers, around these markets and ways to sort of think about those. Because I think one of the things we always try and do is figure out, besides the technology, to the numbers, to the economics, to the financing, does the math sort of math, if you will. And so I wanted to kind of dig into that, kind of drive into that, and see if we can make any sense of that right after the break. Self-driving cars, delivery drones, and fleets of automated mining machines have moved from headlines to habits, but they can only travel as fast as the tech underneath it. On Interconnected, a new show by Equinix that explores the hidden infrastructure behind our connected future, they shed light on the challenges of scaling safety, where computation happens, and a future where cities are built with autonomy in mind. MIT research scientist Brian Reimer and emerging technology leader Patrina Steele explain how the way we move is changing and where the future will take us. Listen on Spotify or wherever you get your podcasts. And we're back. And as I mentioned at the top of the show, I want to dive into some numbers. And, I think what a lot of us have been looking for the last, 12 to 18 months or so, as the world has sort of shifted from, being very much in the middle of the cloud era to very much at the beginning of the AI era, is trying to make some sense of stuff, because there was so much happening. There was so much going on. There were so many things happening very quickly, whether it is a new round of funding, a new valuation for some startup, a new projection of how much power is going to be needed for, all of the GPUs that OpenAI wants to roll out by 2030 or something along those lines. And they come along, and I think at some point we've all become very familiar with numbers because of the amount of data that's in our day-to-day life, the ability to track all sorts of things, whether it's the number of steps that you have, or what's your heart rate, your health related things, or maybe you're into gambling and so you're looking at lines and overs and unders. Maybe it's just the data within your job. Maybe it's all sorts of things. So on one hand, I feel like we have more familiarity and comfortableness with numbers than we did, say, 10 years ago, right? But at the same time, we're now dealing with numbers that are, in many cases, so big and changing so quickly that people can't really wrap their head around them. And as I was thinking about, what, how would you explain? Because I'm seeing more and more just in my day to day life, whether it is people that I work with, or coworkers, or clients that I work with, or even just people in my neighborhood, and they're starting to interact with AI in one way or shape or another. They could be a teacher, they could be a fireman, they could be whatever they might be, and they'll oftentimes ask, like, explain all of these, explain some of this stuff to me, because it's impacting their lives in different ways, right? It could be them looking at the stock market and being like, oh, the market is way up, and a few of these companies, Google and um, Meta, or Nvidia, or whatever, those numbers are way up, so make sense of that for me. Or hey, I've been starting to use ChatGPT, and it seems to do all this stuff, so make sense of that for me. They're like, is everybody just getting that thing for free? Or how does that do that? Or we see numbers every week from company earnings, and then for example, like, it could be Amazon, but it could be UPS, or it could be any other company who was like, oh, they had a layoff, and then people are trying to figure out, well, are those numbers, the numbers of the laid off number of people, are those normal numbers, right? Like, is that a percentage of the company that you might look to trim, or be more efficient because of the way the economics are working? Or is that a really large number as a percentage of their company? Or was that driven by AI, or did that have nothing to do with AI? And so I feel like we have this sort of interesting mismatch of sort of interest in the space, numbers that are coming out, and it's very hard to sort of paint a picture that you can kind of explain to anybody. So just to throw a few things out that I've heard people talking about over the last week or two, or whatever, right? So on one hand, if you think about, let's just take sort of like economics, for example. So right now, the global economy is essentially all being propped up. The growth of the global economy is essentially sort of riding on the back of, and all being propped up by, basically 7 stocks, right? So people talk about, like, the Fortune 500 or the S&P 500. It's really sort of the the Fortune 7, or the S&P 7, and the other 493, because the other 493, essentially, if you look at their numbers, their growth essentially is flat. If you look at the sort of what they call the Magnificent Seven, and to a certain extent, it all very much is reliant upon people like Nvidia, or maybe even Google. Their numbers are up 20%, 30%, 50% for the year, and so many people are looking at, like, for example, their retirement accounts, and they're like, oh, well, if I'm invested in those things, stuff is up, and so maybe the market is really healthy, right? So if you look at it from that perspective, it's like the numbers tend to be tied to a very small number of companies. There's a high concentration around those companies, and people are sort of like, well, explain to me why this company, Nvidia, this company with the funny name, is worth $5 trillion when just 3 years ago they were worth $400 billion. Like, what changed, right? What would make them, more than 10x, 12x, or whatever, what their value was. And so you start sort of explaining stuff to people. Or you take the flip side of that and you go, well, let's, Michael Burry, who is famous for having sort of predicted the housing bubble in 2008, was sort of immortalized in the movie The Big Short. Just took a short position against a number of companies, in which I think Nvidia was one of them, and Palantir was another one of them. And his big number that he's looking at is, how long should a company use to depreciate a GPU? Meaning, what is the useful length of time of a GPU? And in accounting terms, what that means is, if you buy a capital asset, meaning if you buy a physical thing, so you buy a truck or a plant or a tool or a computer or a GPU or whatever it might be, the way that you account for that is, instead of necessarily taking all of the cost of that item in 1 year, which you could do, what accounting tends to tell you is you should try and align the cost of that thing to its ability to generate revenue. So, for example, if you bought a truck to be able to do something for your job. Maybe it moves dirt, or maybe it hauls people, or whatever it might be. And you think, well, a truck typically lasts about 5 years. What you would typically do is you would go, okay, I'm going to depreciate 20% of it every year, with the assumption that I will also be able to make money from that truck for 5 years. And so you're kind of matching the time frame at which you're making money with the truck and the time frame of its its depreciation, or it's losing its value over that time. And so one of the big questions as this relates to AI is, are the companies that own a lot of GPUs, i.e. the hyperscalers or some of these other companies that are related to the AI space, are they depreciating their GPU purchases too quickly or too slowly? And so what's the right number for how long it should take to depreciate a GPU? Should it be 2 or 3 years? Should it be 5 years? Typically for compute type of projects, maybe you would do it over 4 or 5 years, right? That's maybe the amount of time before either the product wears out, the technology wears out, or it becomes irrelevant for its ability to keep up with the pace of change that's happened, right? And so there's questions about basic things like, how long should I depreciate this piece of computing hardware, and should it be the same as I did for GPUs or CPUs, non-accelerated computing, or should it be its own sort of way of thinking about stuff? Does it do stuff differently? Does it, and depending on what that number is, what the right number is, or what number you end up using, is going to have an impact on whether or not you have a lot of expenses or a smaller number of expenses in any given period of time, and you can imagine, depending on, if you're trying to project profit numbers or revenue, well, not revenue numbers, but like profit numbers, the less expense that gets depreciated in a given year could make the profit numbers look higher. If you had more expense depreciated in a given year, your profit numbers could look lower. And, again, if you're trying to be somebody who forecasts the market or predicts what the value of a stock is going to be, knowing what the profit level is going to be is very, very important. And, at this point, again, it's a number that we don't necessarily have a consistency for, right? But if you start getting into other things, so for example, I just wrote down some kind of questions and checklists for myself, right? Like, how do I measure the whether or not one model is better than another, right? How much better is a Gemini model versus a CoPilot model? Kind of hard to do. I know there's things on Hugging Face and other places that will measure it in a very data science-y way for given sorts of tasks. Maybe they are, generating human English text. Maybe it's used to like write something, or is it for doing math? Is it for certain kinds of scientific computation? Is it for things around STEM-related activities, or is it around generating video? I mean, there's dozens and dozens of ways to do it. And there's not really a number. There's not a way to say this thing is 20, 30, 56% better than another one, right? So another sort of number metric that we don't really have a great way of going, yes, this better, this less. Other things, how do we measure the impact that AI has for workers, for knowledge workers, right? So for example, how much improvement should I get for a software developer? How much should I get for a knowledge worker, right? How do I necessarily measure that, right? Because on one hand, you could say, well, it could write you, maybe you measure it in lines of code. Okay, well, that's one way of measuring it. But is measuring lines of code the most important number to be using to figure out software developer value? Should it be in number of projects that they work on continuously or simultaneously? Maybe, right? Is it, does it add more time that developers are actually working on software as opposed to sitting in meetings? Maybe that's the number, right? Or maybe you just start saying, well, I have 10 developers. They cost me X amount of money. I really would love to have 25 developers, but I can't afford 25 developers at full price, but I could afford one additional developer. And maybe if I'm giving every one of my 10 developers $200 per month, so $2,400 times, 10 developers is $24,000. You're like, well, wow, I'm getting one additional developer. If that's how much gain you get for probably the cost of 1/10 of a developer, right? So maybe that's the way that you want to do the math. And again, it comes back to being like, there isn't a specific measurement or a specific number that tells you what that should look like, right? How long should it take for me to get a model to understand my company's data, right? Is that something that should take a week? Is it something that should just happen automatically because I use a RAG use case and I can just, import my data into some sort of vector database? Is it something that I have to, tune and tweak, and that might take 3 or 4 months? So that becomes something that you go, okay, well, how do I translate that into how it impact the business? Somebody has an idea in the boardroom. Somebody has an idea in a all hands meeting, and you want to go implement it. How long would that actually take? We don't really know that answer is. Maybe the question you're asking yourself is, how many workers can a company displace with AI? Right? That might be a number that private equity might want to know if they're going to invest in an industry. It might be something that the financial markets might want to know. Might be something that HR might want to know. And there's not an easy way to necessarily go, hey, this is the makeup of all the work that our company does. These are the available tools for us. What could we do in terms of changing the dynamics of how many people versus autonomous agents we have working? Those aren't numbers that are easily available. And so I sort of throw all this stuff out there on one hand, because the thing I've been trying to figure out is not necessarily the answer to those questions. It's more the answer to, are people acting rational right now, basically 3 years in post ChatGPT coming out, for the things that are happening around AI, whether it's investment, whether it's the amount of resources to apply to things. And what I kind of keep coming back to is, on one hand, there are numbers that are being thrown around that seem incredibly irrational, right? So, for example, just as a simple thing, people, if they've been listening to this show, if they've been following along, they know kind of how much investment has been going into, for example, OpenAI from third parties, whether they're venture capitalists or companies like NVIDIA making investments in them. And then they look at, okay, that's how much money they have, and they're going to have a burn rate, and that's maybe they have $150 billion in cash, and they're burning through $30 billion in cash per year. So that would give them a 5-year burn rate, right? Then just kind of throwing numbers out there, those might not be exactly right. But like, for example, there was an interview that happened a couple of weeks ago in which Sam Altman, CEO of OpenAI, got asked, hey, how do you rationalize the fact that right now you appear to have about, 13 to $15 billion in revenue, and yet based on a bunch of announcements that have been made, whether they are to NVIDIA or Oracle or, a number of other projects and so forth, you seem to have committed about $1.3 trillion worth of spending that your company's going to need to do to, acquire GPUs and data center space and all this stuff. So essentially it was hey, it appears that over the next 5 years, you are going to spend 10x, maybe it's 100x, I have to look at the numbers, what you have in terms of revenue. And how do you justify that? Like, how do you rationalize that? Seems like getting way over your skis. And, so those are numbers that people kind of go, oh, okay, those seem maybe like they are irrational, right? On the other side of the coin is you go, okay, but let's sort of put some things in perspective, right? And so I've been going back and looking at, for example, on one hand, I would look at like how much power is OpenAI talking about having to generate to be able to do the things they do. And you look at that and you go, okay, they want to be at 26 gigawatts by 2030 and 250 gigawatts by 2035. And then you say, well, okay, how would you generate a gigawatt of power? Well, today, if I needed to do that, if I needed to generate a gigawatt, 1 gigawatt, you build a nuclear power plant. And so you go, okay, how many nuclear power plants are there in the world? Well, today there are, I looked this up, there are about 440. There are about 100, a little less than 100 in the United States. And, most of those are already currently being used. They power, they power entire countries and so forth. And you go, okay, so, let's say they're at, 5 gigawatts a day or something like that, or 6 gigawatts a day. They got to generate an additional 20 or 25 gigawatts. That would be 20 or 25 nuclear reactors. How long does that take? Well, I went and looked that up. It takes about 10 years or so to, get approval for a nuclear power plant. And it takes, it says somewhere between 10 and 20 years. Let's just assume that regulatory things speed up a little bit. Maybe it's 5 to 10 years. But then once you do get approval for a nuclear power plant, that's going to take an additional 5 to 10 years to build one, right? So you go, okay, now I need to multiply that by 20. Are those things happening in parallel, right? And again, this gets into a lot of things that are outside of the technical realm, but they get into the realm of like, are we thinking rationally about the numbers that are being thrown around in order to be able to get to some of these big growth numbers that are expected to justify the valuations of stuff that's out there. And to a certain extent, you can look at that and go, this is completely irrational, right? Like we don't have those capabilities today. Now, the flip side of that is a couple of things. One is, Ben Thompson had a really good article. I'll put a link to it in the show notes where he talks about, the value of bubbles. And so he's been going through trying to, again, like many people, trying to look at past technology trend, big shifts or things that look like bubbles, whether they were technology driven or finance driven or whatever they're doing. And do we see parallels to that? Are there things that we can look at, red flags that we look at, growth numbers that we look at? And one of the things that he highlights is one of the benefits of bubbles or sort of bubble mentality is that people start to realize that to solve problems, you have to do them in parallel. And they don't have to be necessarily coordinated in parallel as if like one company has to do everything. But if we think about the AI space, it's like, well, what are things that are going to have to happen in parallel? Well, models are going to have to get increasingly better. They're probably going to have to get increasingly more efficient. They're going to have to get increasingly probably cheaper to build, but they're going to have to get better. Which means they're probably going to get bigger. So you got a bunch of stuff going on in the data science space. At the same time, you've got the ability to then run them in production, which requires a whole bunch of chips. In order to have a whole bunch of chips, you're going to have to manufacture a whole bunch more chips than we do today. We don't necessarily have that capacity through TSMC and other things. So you're going to have people like TSMC, but maybe Intel or AMD or whoever else is going to have to figure out in parallel, how do I increase the capacity to build chips, just chips as a whole, GPU accelerator chips in particular. So that's going to happen in parallel. At the same time, you're also going to have the ability to, once those things start running and you have to turn them on and you have to cool them and all the things that require electricity, you're going to need a lot more power than exists in the world today. So I think I looked at the numbers, by 2030, the numbers that OpenAI are forecasting, plus a few others are forecasting the really big numbers. They're talking about a need for like 50% more power than exists in the world today, to be able to power all these things. And so you go, okay, there are people working on energy generation and small, different ways to build like nuclear reactors or micro reactors or, the ability to maybe do that faster or, whatever sort of bottlenecks are getting in the way. And you're like, okay, so that's sort of happening in parallel. And again, whether we will get there in the time frame that people have already forecasted, who knows? Whether or not we will come up with brand new scientific breakthroughs to be able to get past, current bottlenecks, whether it's in power and cooling or footprint or number of data scientists we have or whatever it might be, who knows, right? Like maybe we will, maybe we won't. It's sort of the old Bill Gates saying of, you never realize. You never realize how much you can get done in 10 years, but you always sort of estimate, I forget what the way it works, but basically it's like you'll get a lot more done in 5 to 10 years than you ever imagined, but you don't typically get as much done in the first year than you sort of originally forecasted because you haven't gone through any learning curves. And so, we have that sort of thing going on. And the reason I brought that up and I went through that long-winded sort of way of going through all those things was from a rationalization perspective, if you are an investor in this space, and you look at the last couple of, mega technology trends, whether it was the internet or mobile or cloud computing, and somebody went back and asked you like, hey, if you had the ability to invest in, Microsoft, Google, and Amazon in 2006, without really knowing how big cloud computing was going to get, or be able to invest in Apple without knowing how big the smartphone was going to get, right? And we all look back on it in 2020 hindsight and be like, oh, well, man, that just makes sense. Just the ability to put computing in somebody's pocket and be able to do it on demand, like that all just makes sense. But it wasn't necessarily, there wasn't a lot of people, there were very, very few people who were like, it will become as big as it will become. And so, we hear about these sort of epic shifts that are happening in technology. We've seen what happens if you are involved early, especially from an investor perspective, in some of these shifts. And so it becomes sort of like not irrational for somebody to go, I'm going to put a large amount of money in here, because they've also seen, many of these games, especially consumer games or, things that are sort of, the backbone of many things. It becomes, very much like winner takes much, if not winner takes all. And so, is it irrational to say, well, if this is the next big thing as they come along every 10 years or every 15 years or whatever, do I want to be on the outside of that? Because if I was on the outside of it before, maybe I don't want to be on the outside of it now. I'm going to find a way to fund this early thing, and maybe I'm irrationally funding it. But at the same time, if you only get one chance to get in on it, then it's like, oh, well, it is rational to, sort of overbet your hand or overinvest, because the numbers that are being thrown around maybe aren't anywhere as big as what's possible, right? So I look at all these sort of numbers, and there are days when you look at them and you go, okay, I can see where somebody would come up with, a bunch of numbers that say, hey, on average, financial advisors are going to be, X amount more productive. They're going to be able to take on more clients. They're going to be able to do more things that drive greater returns for their clients. And, maybe it's 30 or 40% better, or 50% better via AI. Or, people that say, hey, the forecast of, what this industry will look like if, it's healthcare, and the ability for scientists to accelerate their ability to get through the number of proteins or their understanding of DNA or whatever it might be to unlock new healthcare cures or drugs or whatever they might be. Like, you can see a lot of that, and you can go, okay, we've seen the beginning of the technology and so forth. And so I can understand why people would be very interested in that. The idea of like, I could get the equivalent of like double the number of developer productivity that I have today at the cost of one developer. Oh, well, that math seems pretty amazing. Now, whether it works itself out or not, or, whether the numbers continue to be at that price point, who knows? But you can rationally sort of see some of those numbers. You can kind of do the math, and you can go, okay, I don't have to squint that hard to do it. And then there's times when you look at some of the numbers for future projections and some of the largest projections, and you go, I mean, this would require every single thing in the universe to line up exactly right at the same time, and people to coordinate, and geopolitics to coordinate, and it not create problems in other parts of the world, other parts of people's lives. So, for example, oh yeah, great, we generated all this additional ability to create power, but if it's driven because one political group says, hey, we're going to unlock, or we're going to loosen regulation to allow these things to sort of happen, and then the price of electricity goes up for a large number of people within a country, and they decide within 2 years to vote that party out of power, things change, and the priorities of things change, and the number of who gets to sort of have a say in that can change radically in a couple of years. And so there is a part of looking at all these numbers that seem incredibly irrational. And I think that's the struggle that I know I have, and I know a number of people have, is trying to keep both the somewhat rational numbers in your head and trying to figure out what a market looks like, and how can you use those numbers to help you make informed decisions, and at the same time looking at what feel like completely irrational numbers, at least within a 2-year time frame, 3-year time frame, 5-year time frame, and go, how are smart people, or people with a lot to lose, making what appear to them to be rational decisions when you're looking at the numbers and you're like, those seem completely irrational. And I think that's that's the context that we're in right now, is that the numbers are both rational and irrational at the same time from an AI perspective, depending on how you look at it, depending on how much you squint, depending on whether the numbers seem personal to you or they seem completely, disconnected from the world. We sort of have to live with all of them. And I think the challenge right now is figuring out some sort of mental model to allow yourself to hold both the rational and the completely irrational at the same time, and constantly figure out, how do I weigh those, right? How do I weigh them at a personal level? How do I weigh them at a company level? How do I weigh them at an industry level, and try and make sense of them? And I think it's becoming harder to do, at least where we are today, and maybe that'll change 2 quarters from now, 3 quarters from now, 4 quarters from now, or something like that. But we have definitely gone from a stage a couple of years ago to, oh, okay, this is all interesting. What's possible, to starting to see the extreme ramp up and the condensed time frame of everything, and have a little bit of, I suspect for a lot of people, what feels like constant whiplash between the rational and the irrational. So we'd love to hear your feedback on this stuff. I'll put a bunch of things in the show notes, just some stuff and some data that we pulled together looking at stuff. But we'd love to hear how people are mentally building some models to help them, sort through this stuff, because it does feel at times, similar to things we've seen in the past, but also times very different and very much sped up timeframes and condensed timeframes and condensed numbers than we've seen in the past. So anyways, that'll wrap it up. Hope you all are having a good weekend. Hope you have a good week ahead of you, and we will talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.